Good morning, good afternoon, and good evening to all the participants joining us from many different countries. My name is Mathilde Mesnard. I'm the Deputy Director of the OECD Environment Directorate. And on behalf of the OECD, I'm really delighted to welcome you to today's Green Talks live webinar. And the topic of today is From Risk to Resilience, Integrating Water into Financial Stability Frameworks. So water is essential to ecosystems, to our economies, to our communities. And in recent years, the world has been reminded of just how powerful and how fragile this resource can be. Too much, too little, and polluted water can be catastrophic. Floods in Pakistan have displaced millions and disrupted industries. Prolonged droughts across Africa, the Americas, and Europe have affected agriculture, but also energy generation. Pollution and scarcity have forced cities from Chennai to Cape Town in South Africa to ration supplies. And these shocks disrupt supply chains. They damage assets and spill over into financial markets. These are not isolated events. They show how water-related risks, once considered local challenges, can now ripple across economies and borders. Recent analysis from the European Central Bank and the University of Oxford highlights that the rising threat of water scarcity alone could put almost 15% of the euro area's economic output at risk. This is a powerful reminder that central banks and supervisors need a clear picture of how vulnerable our economies and financial systems are to nature degradation, and particularly water-related risks. Today, we are launching the OECD report, Embedding Water-Related Risks in Financial Stability Frameworks. This is a report designed to help financial authorities integrate water-related risk into supervision and financial stability assessments. It highlights what makes water risks unique, how they transmit to financial systems, and where existing data and models still fall short. It also outlines how regulators, financial authorities, policymakers, and the water community at large can work together, opening the door to more informed decisions across economies. Over the next hour, we'll share the report's key findings and recommendations. The full publication is freely available for download via the link in the chat, and we invite you to explore it in more details. We are very honored to welcome an exceptional panel of speakers for today's Green Talk, bringing experience and leadership from both European policy and central banking. So please join me in welcoming Mr. Jan Sissens, if he has joined the panel now, Deputy Head of Cabinet, Environment, Water Resilience and a Competitive Circular Economy at the European Commission, and Mr. Juan Carlos del Rio, Head of the ESG Office at the Bank of Spain. So following an initial presentation by my colleague Lila Davis, policy analyst in the OECD Water team and the lead author of this report, our panelists will share reflections on the relevance of the report's findings for their own work. After our discussion, we'll open the floor to your questions, and I encourage everyone to use the Zoom Q&A function throughout the session also to share your thoughts and your questions. We'll address as many as we can. And as we begin, let's focus on solutions, because managing water-related risk will take coordinated action across regulation, supervision, public policy, and the private sector, especially as pressures from climate change and nature degradation continue to intensify. So thank you again for being with us today. I look forward to an engaging and insightful discussion. So without further ado, I now invite my colleague, Lila, to present the key findings and recommendations of this new report that we are launching today. Lila, the floor is yours.
Thank you, Mathilde, for this introduction. I'll now share my slides. Okay, brilliant. So thank you again for this introduction, and I'm delighted to be presenting some of the key highlights from our new report, Embedding Water-Related Risks in Financial Stability Frameworks. Over the next 15 minutes, I'll walk you through why water matters for financial stability, how supervisors and central banks can and have already started integrating water into their frameworks. And these insights will be complemented, of course, by perspectives from our esteemed panelists from the European Commission and from the central bank. So first, just a few words about the report itself, which you can download using the QR code shown here. This work focuses on the unique challenges posed by water, and it brings together the latest thinking and emerging tools to support central banks, supervisors, and policymakers. The report has three main objectives. First, to help financial authorities better understand, identify, and assess water-related risks. Second, to strengthen communication and coordination between policymakers, regulators, and financial authorities to support improved decision-making across economic sectors and financial systems on water-related issues. And third, to help stakeholders identify where new capacity, data, or partnerships are needed to evaluate the financial implications of water-related risks. In short, the report aims to build a shared foundation for integrating water into financial stability frameworks. Of course, I'll only be able to touch on some of the key messages today, but I warmly invite you to explore the full report, which goes into much more depth on the tools, frameworks, and also a number of examples we've brought together. So of course, let's start with water. Our economies rely on a stable hydrological cycle, and water use is critical for nature, for people, and for our economies. We know that the planetary boundary for fresh water has been crossed. In practical terms, this means that human activity has pushed the planet's systems beyond their pre-industrial stability into a space where there is a real risk of large-scale, abrupt, or irreversible environmental change. The hydrological cycle also plays a key role in climate change. Water is one of the main challenges for impacts of climate change, notably through drought, floods, and changing rainfall patterns. But at the same time, when freshwater ecosystems degrade, the planet's capacity to absorb carbon is weakened, which contributes in turn to climate change. So when we are speaking about water-related risks, we mean three things: too much or too little water. And indeed, by 2050, nearly 1/5 of the global population is expected to be exposed to flooding, and more than half to water stress. Polluted water. In a study of 258 rivers, over a quarter were found to contain pharmaceutical pollutants above safe levels. Degradation of freshwater ecosystems. Since 1970, freshwater biodiversity has fallen by 84%, which is the highest decline across all ecosystems. These figures make one thing clear: water is not just an environmental concern, it's a systemic risk factor with profound implications globally. Water lies at the heart of economic and financial systems. When its availability, quality, and spatial distribution are under pressure, this creates challenges for economic productivity and financial resilience. Many of you may be familiar with this type of diagram, which shows how environmental risks or nature-related risks transmit through the economy into the financial system. Here we've applied it for water specifically. So first, on your left, there are risk drivers, including climate change, unsustainable water use and pollution, and land use change, all of which degrade freshwater systems and can reduce their resilience. Second, we see the sources of risks. So these are both physical and transition in nature. Physical risks, such as droughts, floods, and pollution, are increasingly visible, as we've just seen. Transition risks arise from the misalignment between economic activities and emerging policies and regulations to protect and restore water resources. Sectors with the largest impacts on water, for example, agriculture, energy, infrastructure, and industry, are also those who are most exposed to more stringent controls or shifting market sentiment, and therefore to these transition risks. Third, we can see this can then translate into economic risks, and a large range of economic sectors can be exposed to these risks, regardless of their direct level of water intensity. This depends on impacts and dependency on fresh water across their value chains and specific country contexts, including the composition of the economy and exposure and vulnerability to water-related risks. These can have microeconomic effects, such as destroyed assets or uninsured losses, and also macroeconomic effects like reduced output or trade disruptions, sovereign risk, which can accumulate. So we've seen this in very tangible ways. We have recent examples of this. For example, the floods in Valencia last year that caused devastation, leading to loss of life and widespread damage. Droughts, which reduced shipping traffic through the Panama Canal, disrupting trade volumes. Water scarcity in Taiwan, which threatened semiconductor production, and there are many more. These shocks can cause capital destruction, value chain disruptions, and price volatility, and can trigger relocation or adjustment of entire activities. Finally, on the far side, we see financial risks. So that's when these economic shocks become a financial risk, and this can show up in credit loss, liquidity stress, underwriting losses, and market volatility. And because financial institutions are interconnected, a shock in one area can cascade through the wider system, amplifying losses and undermining financial stability. So this is what we mean when we say that water-related risks can become systemic. So now there is broad consensus that central banks cannot ignore climate and nature risks. It's in their mandate to safeguard price and financial stability, and this has been confirmed by the Network for Greening the Financial System and numerous central banks individually. While it's still at an early stage, many authorities are beginning to integrate climate risks into macroprudential measures such as stress testing. Central banks, including the European Central Bank, the Bank of England, the Dutch Central Bank, have developed sector-specific stress test tools and built internal climate teams and embedded climate scenarios into supervisory practices. And increasingly, climate stress testing exercises capture water-related shocks, such as droughts and floods, which can have major financial implications. And so here I've put a few examples. For example, a stress test in Morocco showed that over a third of bank portfolios could be exposed to drought risk. This is linked to lending in the agricultural, food processing and tourism sectors, as well as households in vulnerable areas. Another stress test found that extreme flood events could impair financial stability in the Netherlands. And this was particularly if densely populated western regions of the country were hit by an extreme event, and notably linked to lending for real estate. But only a few authorities have started piloting nature-related scenarios, which go beyond the climate lens. The implementation gap reflects the newness of this broader approach, limited but growing analytical capacity, ongoing data constraints, and evolving mandates on nature. Nevertheless, this work is expanding quickly. For example, the Hungarian Central Bank collaborated with the OECD on this. The UK has also done several studies with Oxford University, and there have been several case studies under the NGFS. And recent studies consistently point to the scale of the issue. The value of water-related risks is estimated to be equivalent to 7 to 9% of global GDP, highest amongst other ecosystems. And this is consistent as well with analysis that was undertaken under the Global Commission on the Economics of Water. There are still major data and modeling hurdles in assessing water-related risks. Many stress tests struggle with the accuracy, granularity, and comparability of water-related data and other data. It is also technically difficult to model compound and cascading events, for instance, a drought followed by flooding or prolonged rainfall interacting with weakened infrastructure. Particularly nature-related scenarios, scenario analysis is very much in infancy. Turning an ecological shock into an economic and financial outcome requires several modeling steps, each with its own uncertainty. But waiting for perfect information is not an option. Delaying action leads to mispricing of assets, misallocation of capital, and risks to the financial system as a whole. That's why regulators and researchers are proceeding with the best available methods, even while acknowledging their limitations. What's important is that each iteration brings us closer to understanding how environmental degradation, and water in particular, can pose real systemic risks to financial stability. So what are the tools for addressing risks in the financial system? Well, there are multiple leverage points. Financial authorities can act through supervision, monetary operations, and management of their own portfolios. So firstly, supervisors can embed water into banking oversight and risk frameworks. The Basel III framework remains central to global prudential regulation, and key entry points for integrating climate and nature risks exist through Pillar 2, supervisory review, and Pillar 3, market discipline. Under Pillar 2, supervisors expect banks to identify, assess, and manage material risks, and several jurisdictions have provided climate and environment-related guidance for this. So for example, the ECB, who's been doing a lot of work on this topic, explicitly reference water stress and pollution in its supervisory review and evaluation process. The Hungarian central bank has taken the innovative approach to apply targeted capital relief for verified green lending, as they have found that evidence of lower credit risk for these operations. Under Pillar 3, Brazil's social, environmental, and climate risk framework requires banks to disclose environmental exposures, including water, improving market discipline and supervisory data. Monetary policy frameworks can also be adapted to environmental shocks. Notably, central banks can adjust their operational tools to reflect these risks. For example, collateral frameworks are a central part of monetary operations. And to manage the associated risks, central banks use collateral frameworks that specify eligible assets and apply haircuts, which are reductions in the asset's valuation to buffer against potential losses. In this context, the Bank of England's integration of flood risk into its mortgage collateral framework represents a significant development. So this is not just about, well, this is not about steering capital flows, but about managing financial risk in this example. And finally, central banks can lead by example. As major asset owners, central banks face the same exposures as other investors. The Dutch central bank therefore piloted the TNFD framework across its portfolios. So that's the Task Force for Nature-Related Financial Disclosures, using tools such as Encore and the WWF biodiversity filter. And this provided lessons which can help the market accelerate its learning. Lessons including starting small, improving location-specific data, and building up institutional capacity. But it's important to note that financial authorities don't act in isolation. They operate within a broader policy ecosystem. At the foundation of this, real economy policies help shape overall resilience. Water security depends on strong infrastructure investments, effective water governance, and sound ecosystem management. When these policies are robust, the likelihood of a water crisis falls, and with it, the credit and operational risks faced by financial institutions. Investment regulation also plays a key role. This includes frameworks such as like the European Sustainable Reporting Standards, ESRS, the CSRD, ISSB, all of the acronyms for corporate disclosure, sustainable finance taxonomies, due diligence obligations, such as the CSDDD, which is the Corporate Sustainability Due Diligence Directive, and also OECD guidelines for responsible business conduct. These give supervisors and financial institutions the data, definitions, and comparability they need to assess and manage environmental risks. And these instruments ensure that prudential regulation is supported by consistent and transparent information on firms' water and nature dependencies. And finally, collaborative governance bridges the financial and environmental agendas. So managing water-related financial risks requires coordinated action across sectors. Supervisors can identify where risks are building up in financial portfolios, but it's governments and businesses that can address them, that can address the underlying environmental and economic drivers. As the Bank for International Settlement notes, tackling climate risks is a collective action and challenge. So central banks can help bridge this gap or bridge these agendas by facilitating data sharing, policy dialogues, and ensuring that prudential standards enable rather than hinder sustainable investments. And so finally, I wanted to share a number of the recommendations that we've included in the report. And once again, I invite you to go look at the report for more detail. But we see that recognizing water-related risks as material to financial and price stability is important to elevate these issues across government agendas. And that's where we see a really important role for financial authorities. Clear supervisory expectations for managing water-related risks can enable financial institutions to address them proactively. And we've seen some really good examples already taking place, for example, in Europe with the ECB. Aligning financial policies with real economy policies for fresh water protection is critical to make sure that efforts are mutually reinforcing, so that we're working together towards a common goal. Embedding water into financial regulation and market standards is important to establish clear rules to support supervision, with view of this broader ecosystem that it operates within. And finally, collaboration is key. These challenges are new and complex, or exploring these challenges is new, and they are complex challenges. And addressing them will require joint efforts across regulators, financial institutions, researchers, and international organizations. So thank you very much for your time, and I'll hand back over to Mathilde.
Thank you, Lila, for this insightful presentation on a fascinating topic. And your presentation highlighted how central banks are already addressing, for some of them at least, water. And also you highlighted where there is in fact still much more to be done, in particular in your last slide. So to reflect on these findings, we now go to our panel discussion. And I have one question for both of the panelists that I will ask you to answer in around 2 minutes. So my question is, water availability and quality are direct sources of economic and financial risk. It was perfectly showed in Lila's presentation. But in your view, what makes these risks distinctive? And why do they stand out as a priority in your own work? So I will maybe begin by Jan. If you're ready to take the floor.
I am. Thank you very much, Mathilde. Can you hear me well?
Perfectly.
Excellent. Very good. So thank you very much indeed for the kind invitation to discuss this study here today with you, which I would really compliment you to, because it is really a matter of increasing, I think, importance and urgency. I think and that is also your question, Mathilde. Why should we particularly care about water? Well, I think the figures are clear, because water is simply, I mean, this is where, let's say, the climate change, the risk relating to climate change and the risk relating to nature degradation, actually they crystallize, and they lead to the most significant impact, the risks, and ultimately also damages. So I think that is in a nutshell probably why, out of the many the broader picture of let's say resilience related risks, I would say, of which I can quote many, this needs to be tackled particularly. And I would maybe like to comment on the conclusions and support very much the conclusions of the study, indeed, which of course raise on the one hand the importance for financial institutions actually to look at this, but on the other hand, indeed, also an alignment with water policies, and because those are risks that indeed probably individual institutions alone cannot address. They can be aware about them, they can mitigate them, but ultimately it is something where also a public policy intervention needs to play its role. And in that sense, I welcome very much that actually the work you're doing is quite parallel to the work we are, for example, doing in Europe. We have recently presented before the summer a new water resilience strategy for Europe, actually, which pretty much tells policymakers what you are telling banks, that this is something they can no longer ignore. And importantly also, regardless where you are, there's a common misunderstanding and misperception has been for all too long that in the north this is not an issue, and water is still available, and we can take it for granted. And that is clearly no longer, even in the north of the world, and in the north of Europe, that's clearly no longer the case. And in that sense, from our side as well, I think we are indeed presenting policymakers on the one hand with the challenges, too much water, too little water, so water quantity, but also indeed continuously taking care and monitoring water quality, because in the end it is fresh and clean water, which both our citizens, but indeed also our businesses need, and in the business case actually to reduce their risks. So here I see a very close alignment actually between the two work streams, and I think that's how it has to be, because the issue needs indeed this collaboration very much, as you concluded, between the public and the private sector.
Thank you, Jan. So I will now ask the same question to Juan Carlos. So what make water-related risks distinctive, and why these are priorities in your own work at the Bank of Spain? Juan Carlos.
Of course, Matilde. Thank you very much for the invitation. It's a real privilege to be part of this Green Talks live series. So thank you. It's very difficult to add something interesting after your comprehensive presentations, Matilde, but I think that my first point should be that water is not only a primary channel through which climate change manifests. So climate change, water, biodiversity, they are totally closely connected, forming a dynamic system where risk and response continuously reinforce one another. But there are two dimensions that make water a distinct risk from my point of view. First, as a natural resource, it is an essential resource for living with a systemic impact on public health. And I think that this is very important from my point of view. And in addition, it is not a renewable resources, or at least its replenishment in terms of quantity takes decades, and in terms of quality, it might require centuries. Second, from an economic point of view, as you, Lila, and Jen has already said, water is a critical vector of cascading risk across ecosystems, societies, and the financial system. And maybe to finalize this question, one interesting issue related to water is that normally water impacts are usually local, but the ripple effects normally are global through supply chains, commodity markets, and credit risks. And all these things, I think, that create a unique risk for the economy, but also for the societies and the financial system.
Thank you very much, Juan Carlos, to highlight how unique it is. And I really like also what you said about to replenish on quantity. We might need 10 years, but in quality, in terms of quality, we might need centuries. So based on this very clear description of how special and important and priority are these water-related risks, I would like to ask you another question, Juan Carlos. Where do you see the most immediate channels of financial materiality for these risks? For example, credit risk, sovereign risk, insurance, or asset valuation, etc.
Yeah, Matilde. The evidence points that credit risk and sovereign risk are the most sharply on material channels, with a growing relevance for insurance and asset valuation. No? But the findings that you already mentioned, a recent paper by the ECB jointly with the University of Oxford and the LSE, show that degradation of water-related ecosystems, such as flood protection or water provision, present the most material risk for the European economy. Specifically, as you already said, in severe drought scenarios, up to 1% of the Euro GDP could be at risk. But beyond this direct economic impact, degradation ecosystem service also undermines the financial stability. After analyzing the portfolio of 2,500 enterprises banks in the euro economy, the result shows that over 1/3 of the total outstanding nominal loan amount, exceeding 1.3 trillion of euros, is currently allocated to sectors facing high risk from surface and groundwater scarcity. And in addition, the 20% of the loan portfolio is directed towards sectors significantly exposed to water quality degradation across Europe. So the evidence is quite clear. In terms of borrowing credit ratings, I think it's very clear the impact, especially in those countries with poor water governance or high exposure to water scarcity. And finally, for insurance, I think that markets are beginning to price water-related risk, particularly in agriculture and real estate, but much more important, much more important, due to the rising insurance premiums. Insurability in certain areas of Europe and the US is under strain. And finally, asset valuation, which is very clear, is similar to climate change. Stranded assets, declining land values in water-scarce regions are also an relevant risk and probably greater in the future.
Thank you, Juan Carlos. Thank you for all your evidence, and it's important these days to base our reflections on evidence.
Mm-hmm.
The evidence is clear, as you said, in terms of the biggest channel might be the degradation of ecosystems, and also your point on insurance and insurability. We are heading quickly to a crisis there, and we see regions, as you mentioned, within the US where there is this problem. So thank you. Maybe a follow-up question for you, Juan Carlos, because you are a central bank, and how can you incorporate this risk, water-related risk, into your supervisory priorities and your risk assessments? And what are the most recent developments and where we need to take greater action?
Okay, well, this is a difficult question because as a central bank, always is difficult to deal with this kind of topics, no? Because some of them are beyond of our mandates. But in any case, this particular question arose precisely last week, in a dialogue between Mrs. Lagarde, the president of the ECB, and the Professor Rockström, the author of the planetary boundaries. Exactly the same question. And the answer of the professor was crystal clear. So what we need to do, systematic approach to connected climate change and nature, collect information from many sources and areas of research, collaboration through guiding, as NGFS is doing right now, using our power as a central bank to attract the best knowledge and scientists in the world to tackle this kind of topics and risks. Pushing our boundaries by publishing all the results and to show the evidence, especially using our voice as a central bank, always respected by the public opinion. And assure that financial benefits and avoid pessimistic scenarios. These are the recommendations from the Professor Rockström. But from a prudential regulation and supervisory perspective, I think that the main messages are perfectly captured by your documents, which is a very clear, comprehensive roadmap for supervisory and financial institutions. But beyond that, I think that we need to be sure that we include water as a material risk as part of the ESG management, such as the new banking package related to capital requirements explained, and integrated environmental risk, including water, into the supervisory review and evaluation processes. Also, as Lila has mentioned, set clear supervisory expectations, improving the ability of market information, and conducting stress tests that include water stress scenarios, such as extreme droughts or watershed degradations, to assess the resilience of the financial sector. My last word I have two more comments, if you permit me. First, I think this is also very valuable, the effort of the Network for Green the Financial Sector, designing scenarios and conceptual frameworks to integrate nature-related risk, and particularly water as a pilot, into the financial system. And in the Bank of España, we have also made a significant effort to broaden our focus beyond climate, including the impact of fiscal climate risk and nature degradation, with a special focus to water. In particular, we have some very recent studies on the environmental deterioration of the Mar Menor in Murcia, in the southeast coast of Spain. Desertification and aridity, and the impact on credit. The Dana effect in Valencia last year, devastating catastrophe on the financial system, and forest fires, all with a strong water-related dimension. And also, we are designing a nature stress test for the coming years in order to deepen our understanding of this topic for the banking sector in Spain.
Thank you. Thank you very much for showing how important it to use all the, I would say, the usual, equipment of a bank, like stress tests, using scenarios, etc. And what you mentioned about the voice of central banks, it's quite important, because to make this topic somehow legitimate, we need to hear from the central banks that they take it seriously. That's how the things began to move related to climate. And I think that now it's how this can begin to move related to nature-related risks. So that's quite critical to me. And it's good that you referred also to the NGFS new scenario, because that's also how this began to move on the climate agenda. So now I would like to go to Jan and ask you a question about, of course, the European level. So the European Commission has recently put forward a water resilience strategy. And how do you see this strategy connecting with financial stability concerns? And what role can financial actors play in strengthening Europe's resilience to water risks? Please, Jan.
Thank you very much. How do I see indeed the connections between your work on financial stability and our indeed the water resilience strategy, which looks at this, of course, very much from the perspective of policy, public policy making. Well, I think in the first instance, and I think I already mentioned this, this is about awareness, and I think indeed in that sense, the message going to the policymakers and the message going to financial institutions, and they sometimes also have contacts and exchange. I think they can be mutually reinforcing each other, actually. Also, I think I welcome that indeed, and that we have the same approach, that you look at water resilience as a broader, or what we look at water resilience as a broader concept in a way, and you do that as well, water-related risks. This is not just about indeed one factor, or quantity or quality. This is not just about, let's say, building water infrastructure, but it's actually a much broader actually concept where you look at where are the vulnerabilities and where do we need to strengthen the resilience. In a way. I think then the second point where I think I see connections is indeed in the risk analysis and the assessment. I think you also make concrete let's say concrete recommendations to financial institutions. In our water resilience strategy, we are also indeed supporting and providing specific support also through tools, for example, the European Copernicus satellite data and others. And we are making this data available. We plan to make it available not just indeed for public authorities, but also for private operators. So I think there are areas where also the public sector, the public side can actually input into the risk assessment process in financial institutions. And I think the European climate risk assessment is, of course, another example where this is quite important, quite relevant, because, of course, the scenarios there then indeed are also one of the input factors, again, which financial institutions need actually to concretely see then how will the water-related risks also develop. So that's the second factor, indeed, inputting data. I hope also then there is a feedback of the data that also financial institutions are also then making available maybe to regions or communes, actually possibly at aggregate form some of the assessments they are doing. So to also, on the other hand, inform indeed then local water planning or other measures. And then I think the third, let's say, level of interaction I see is actually in the area of the action, which then needs to be taken from on the public side, and that we strengthen our water resilience strategy. We have a quite solid regulatory framework in place, at least in Europe, in the EU, actually, for water planning, water resilience. But what is missing is, of course, action, it's implementation, and that means also investment in a way. I think how to get there, on the one hand, it's the collaboration, and I think that you stress as well, indeed, actually bringing the different actors who are affected by water stress together at the table, because it's very difficult to address, very often to address water-related risks just as a public sector or just at the private sector. I mean, you need actually to even possibly the cities which are downstream, and maybe the rural communities which are upstream, or the farmers. You need them actually to work together, and then possibly with the companies who are affected actually by water stress, to provide sustainable solutions. And so I think this collaboration is something which we are pushing the policymakers to do, and I think a proper risk assessment on the water side would actually then also encourage the private financial institution to do that. And then I think last but not least, when it comes to the actual money to be spent, I think we are putting quite a lot of money on the table. The European Investment Bank has provided 15 billion euros over 3 years in the recent cohesion fund review. Actually, we have encouraged all member states to make water a priority, water resilience. But there also needs to be indeed private investment. The two need to go together. And I think the clear assessment in a way of the water-related risks is probably, for me, one of the strongest drivers actually also of encouraging private investment in water. So I think those are the areas where I see indeed convergence, awareness, analysis, and then investment.
Thank you. Thank you to bring this investment aspect, because it's quite fundamental also to put things into motion. So I have another question for you, Jan. It's again related to the EU Sustainable Finance Initiatives, you know, the taxonomy that Lila mentioned, the CSRD, the due diligence directive, etc. So what role these initiatives can play in providing supervisors and markets with a stronger enabling framework for managing exposure to water-related risks?
Yeah, indeed. I think let's say this new sustainable finance framework provides, well, on the one hand, it also provides indeed supervisors with a mandate actually to assess certain risks also when they actually carry out their mandate. So it is a support actually and confirmation actually for this activity as well. And on the other hand, then when you look at it from the perspective of the private institutions, indeed, I think the various indeed assessments and requirements indeed to look at sustainability profiles will of course encourage indeed then also private institutions to actually to look at these matters. Now, I think you know that we are currently undergoing a, let's say, I would say, consolidation or also simplification of the framework. So this is something I hope personally that there will be quite good clarity quite quickly on indeed the steady state, including hopefully also much simplified standards actually to be applied then for companies. And that should then also probably be a good basis indeed to also really to apply this in practice and make the best possible use out of it.
Thank you. I would like to give you a last question, but really ask you to answer shortly, kind of in 2 minutes. You mentioned the collaboration, the need for collaboration between public and private, Jan. So if we look at collaboration more broadly between central banks, financial supervisors, policymakers, environmental agencies, academia, etc. So what are the forms of collaboration that are most needed according to you, Jan?
I would say on water, I would say that what is particularly would be important and what is still really missing also where there's a blank spot is actually not the cooperation at the European or at the national level, but it's more the cooperation actually at the regional level where the problems are actually crystallizing and where also the risk assessment needs to be taking place. That is, I think, where probably I would see the biggest blank in a way, or the biggest need for addition, because I think water management and financial supervision and financial institutions are not communities who are very often in touch in a way. So we get, let's say, plans under our Water Framework Directive, which are pure, I mean, focusing quite strongly on the public authorities, the investment needs basically, but I see personally very little interaction there then indeed with that. And that's something we also want to promote on our side from the European side with the European Water Resilience Strategy. We also will have what we call the Water Investment Accelerator, actually, which precisely encourages good practices of these projects, which bring together the different operators on the ground, indeed.
Thank you to remind us of this very also special aspect of the water question, you know, this regional aspect. Now, I have the same question for you, Juan Carlo, in terms of what are the collaborations in your view that are the most critical? And also, if you have one message for financial authorities that are just beginning to look at these issues. So your peers that are less advanced than the Bank of Spain, basically, what kind of advice would you give them?
Okay, thank you. Thank you, Matilde. I think that there are many issues that we need to work on that in a collaborative way. Developed scenarios-based stress test, using forward-looking models to simulate water shocks and the transmission through the financial system, enhance data infrastructure, as Jen has mentioned, invest in satellite data, geospatial analytics, and sectoral benchmarks. I think it's essential, it's crucial to consider relevant the cross-check impact across different areas, because sometimes research from one side, financial stability, politicians, multinational organizations. So we need the cross-check validation of our research and analysis. I think is crucial, and for that it's necessary to collaborate. The international transmission also requires a strong collaboration effort. And maybe for us, for a central bank, probably it's quite easier because foster future collaboration with national central banks with a lot of appetite to collaborate in terms of water-related risk, at least in Bank of Portugal, Bank of Italy, Bank of France, ECB, Bank of Greece, and of course the Bank of Spain, but also NGFS, OECD, and other multilateral organizations. No, and probably the best example of this collaborative commitment is that we are designing an international conference next year jointly with you at the OECD in mid-May, as a proof of our commitments in terms of water-related risk for the financial system, just after a global water summit also in Madrid. So in May, we will have a whole week talking about water, first from a corporate regional perspective, as Jen has said, and also from the financial and central bank perspective. And this is the best example of fostering collaboration. No? And my last message, probably the main message that I can imagine is don't wait for perfect data and models. Begin with imperfect collaboration. Probably, as we are doing in Spain, is in an extraordinary initiative called the Council on Sustainable Finance to mitigate climate change effect and trying to capture the SME attention on this topic. And you can mimic or apply this initiative in order to starting with an imperfect collaboration, imperfect data models, but go ahead. Thank you.
Thank you. That's an excellent conclusion, I think. We have some time for the discussion with the audience. That's good because we have a couple of questions now coming. Let me ask you one from James Mikael. How are banks now equipped with the tools you are suggesting? So in terms of the banks, not the central banks, but the banks, how do you see in Spain, for example, you know, the banks being beginning to equip themselves even with imperfect data?
From my point of view, I have the advantage that I came from the banking sector, from the banking industry. I work very closely with the whole finance, the whole banking system in Spain. And I can say that probably the most relevant tipping point effect was caused by the stress test on climate change. So after that moment, the banking industry in Spain and probably in Europe needs to capture data, make estimations, improve our models, how to translate all this knowledge and understanding into credit policies and commercial practices. So I think that I think from my personal experience in my past life that the central bank has an important role making an inflection point of this debate. If we consider that water-related risk is material, introduce or emphasize the water into the ESG management risk, and then apply to the next stress test scenarios for the next future. And this is the best way that the banking industry reacts and adopt all this information, all this effort in order to capture, in order to improve not only the financial risk, but also the opportunities behind of this effort.
Thank you. Thank you very much. I have a question for maybe more for you, Jan, from Gertjan Storm. What distribution of roles between governments and central banks? For example, in the EU context, both are facing the same shared risks in asset stranding. So, for you, maybe, Jan?
Yes. What is the distribution of roles there? I mean, I think on the one hand, when it comes to asset stranding, I think I mean, both need to work on reducing the risk for asset stranding in a way. However, indeed, I think the public side can do it only in terms of a macro picture. Indeed, as Juan mentions, and the study points out, indeed, of requiring financial institutions to put together the necessary strategies and assess their risks. Or then, when you look at more the water authorities or others, indeed, to reduce big let's say risks. But I think the actual application of it then indeed needs to be done at the level of individual institutions. They're much stronger when it comes to actually assessing the specific needs and risks on specific assets or in the specific situations. So that's maybe a bit the distribution, macro versus micro.
Okay, and I have a last question. I'm not sure to whom. I read you the question and you'll see whether both of you want to answer. From Touba Atabe. So the question is, in order to better assess and track the risks by banks, what's the better way of risk assessment between tracking sources of risks like flooding, droughts, versus tracking risk drivers such as land use change, pollution? And if it's the latter, that means land use change and pollution, would there be any role that the banks can play through land use, pollution issues, etc.? It's a bit a long question. If you have any elements of answer for Touba.
Well, I mean, in a way, I think you need to, well, okay, this is the obvious answer. You need to look at both in a way. I think ultimately, for the individual risk assessment, I think the sources of risk are probably the most important one, because you need to concretely see in your situation where does the risk concretely come from. But I mean, then in assessing these sources and assessing how important the risks are, of course, the drivers also play a role. So climate change, for example, is, I guess, a driver. So you need to take that into account when assessing how important a source of risk actually is. Now, I mean, the second part of the question is then what influence do banks have actually on land use change and other matters? That, I mean, of course, in theory, the lending policy would can have a significant influence. Now, whether I think banks want to use that or not, I think that is I think, a commercial decision ultimately.
Exactly.
Thank you. So I think it's about time to wrap up our discussion. It was very interesting. So I thank you, both of you, and I thank Lila for her great presentation. So this discussion had made clear that water is not only an environmental issue, but also a core economic and financial concern. As Lila mentioned, changes in water availability and quality are already shaping production, trade, and investment, and with them the resilience of our financial systems. And these risks are real, they are growing, they are increasingly systemic, and we have heard from our two panelists how, from the EU public policy or from a central bank perspective, what is beginning to happen in this area and how important in particular is the role of central banks. I will not try to summarize, but there are three messages that I found super important, in particular in the current context. It's first, all you said about evidence, the importance of data, gathering data, etc., even imperfect data. As you said, Juan Carlos, don't wait for the perfect data because it's a complex area. It will take time, but we do begin to have enough data to move, to raise awareness and to move. So that's the first message on data. It's crucial. The second message is on collaboration between public actors and private actors, regional collaboration from the water perspective, also collaboration in developing scenarios, as the NGFS is doing, in developing stress testing, collaboration also on data infrastructure. So all these collaborations, they might be imperfect, but they are needed to advance in this agenda. So that's the second message. Imperfect, but growing collaboration is needed. And the third message, we dwell less into it, but it's important also, money investment. We need to invest, So to make the risk, to try to decrease the risk de facto. So we need a big investment in this sector to decrease the risk related to water. And last point, I will go back to your initial message, Juan Carlos. The voice of central banks is critical to make this agenda move and to make this agenda more legitimate and more taken seriously. So, and we have seen that recently, these are the central banks which have moved, the Dutch one, the Hungarian one, the Spanish one, so, and the NGFS. So that's very important that the central banks move because it makes this agenda super legitimate. And thanks for inviting us to this week in Madrid next year, Juan Carlos, the water risk week, if I well understood. So we will be delighted to contribute to this week. And let me tell you now what we'll do. So we will, of course, continue building on this work in the month ahead, including through deeper engagement with central banks, because we do recognize that it's a key actor in this agenda. And also through the Roundtable on Financing Water organized by the Bank of Spain in May 2026. So with this, I want to thank you all again, Lila and Juan Carlos and Jan, for your fantastic presentations and discussion, answering questions, etc. And please visit our website to access this specific report, but also all the related resources that we have on water. We do a lot of work on water. And I invite you in particular to join us during the COP30 in what is called the OECD Virtual Pavilion. That means on website, we organize a lot of panel discussions and they present key analysis data reports, such as the one we discussed today, related to climate change and broader nature-related issues. So you will find the link to the virtual pavilion in the chat of this meeting. And with that, I think I can close the webinar. Thank you again, all.
Thank you.
Have a nice
Thank you very much.
Thank you.
Goodbye.